Hello and welcome to our second of two webinars focused on current markets, especially heading into the election and into 2021. I'm Danny Mock. I'm one of the partners here at FMB Wealth Management. I've got my master's in economics, so I'm the house nerd, the resident nerd. I get to talk about all the numbers and the nitty-gritty of things. So it's a total pleasure to be able to talk to you today about part two of interest rates and fixed income as it relates to the world today, where we're at, where we're headed, and what does it mean for us as investors and for planning going forward. So we wanted to follow up last webinar that was focused mostly on the stock market with this topic, because if you've been working with FMB for any length of time whatsoever, or if you're just an investor in general, you probably have some sort of fixed income asset in your portfolio. And you might even be a borrower, like a mortgage or a car loan or something like that. And so interest rates are probably really pertinent to your life. And so we wanted to address what's going on. Where have interest rates been? Where have bonds gone? Where they're at today, and what to do about the future that's completely uncertain. We don't know what markets will do going forward, but we have to plan for the future, not just in the next couple of months getting through the election and into 2021, but we have to plan for a whole lifetime of being an investor and being a borrower. So we wanted to talk today a little bit about what are the implications of the new interest rate environment. Super low. Great if you're a borrower, tough if you're a saver. And so today we're going to dive into a little bit about what this means for you as an investor and as a saver, and then how to deal with this new kind of dynamic that we're experiencing today. So what I'm going to do is I'm going to walk through a couple of things. What are interest rates and bonds? And this is probably somewhat of a review for most investors, but we wanted to touch on the different types of fixed income vehicles there are, and how they have different applications for planning for the short term and for the long run, because they play an integral role in building a really robust and sustainable financial structure. And it's really important when we plan for the future. So we'll talk about what are bonds, how do they operate, and how do we look at them in a planning capacity? Where have they been? What have they done for investors, and what have they done for savers to this point? And then how do we think about investing in a really low interest rate environment going forward? And then we'll talk a little bit about some of the common questions we see when looking at a bond portfolio, or how do we just deal with this? So we'll dive right in. Again, I'm Danny Mock, and with any of the topics that we discuss, if you're working with FMB, please reach out to your advisor if you have any questions or want to talk more at length about this, or if you're not working with FMB currently, please reach out to us. We'd love to be a resource for you and the ones you care about, especially heading into the 2021 with a ton of uncertainty in the world. So let's just dive right in. What I'm going to do is I'm actually going to be able to do a little bit of sketching while we're talking. So I'll pull up my whiteboard here. So first thing to understand is kind of what are bonds, what are fixed income vehicles. It's pretty simple. It's basically just a promise that someone's going to pay you back. And this is probably a review for most people, but when we're thinking about bonds, you have to figure out which side of the table you're on. If you're borrowing money for a mortgage, you're the borrower and you're paying someone back some set of income stream. And when you're an investor in bonds, you're the exact opposite of that. So you're loaning someone money who's going to pay you back interest over time. And there's a couple of different ways to think about bonds. And what we like to do is we like to split them up into two different categories, primarily, which we have nominal. And nominal bonds basically pay just a flat level income, call it 5% every year or whatever it is, but it stays flat through the entire life of the loan. And what we'll see on these is these are going to be things like corporate bonds, and these are going to be things like municipal bonds or munis, or treasuries, or agency. These are all different types of nominal bonds. You might even see things like mortgage-backed securities. Those got some notoriety in 2008 for being a part of the financial crisis, frankly. And then there's another one called zero coupon bonds, and we're not going to talk a lot about these today, but these are all types of nominal bonds. They pay a fixed rate irrespective of inflation. Now, the next set of bonds to think about are what we call inflation bonds. And it's a pretty short list, quite honestly. There's things called Treasury inflation protected securities, or TIPS, and only the Treasury can issue these, and they're very similar to nominal bonds, except when inflation goes up, so does the payment. So if inflation climbs 3%, your original payment, whatever your coupon payment is that you're earning interest on the bond, is going to go up by 3% or whatever inflation is for that year. Now, one thing to note is there are opportunities that that can be not a treasury issued security, but they're called synthetic, if I can spell this right, synthetic tips. And these have their place in planning as well. The only difference is they're not guaranteed by the treasury, but they try to operate in a very similar way. And so those can play a role in planning. So why am I talking about inflation at all? Like, we've historically had really low inflation over the past couple of years, and you might hear in planning terms, well, average inflation has historically been 3%, and so a lot of times that's a planning figure that'll be used, and that's fine. Recently, it's been closer to like 1.5% over the past few years, and there's some relationship between interest rates and inflation. And everyone knows kind of what inflation is, the cost of things getting more expensive, but I think it's really good to talk about a really tangible example. And so, so just out of my own curiosity, I said, what has the price of milk done? That's kind of one of those long-term staples people have had in the things they buy, right? And so I was curious. So I wanted to see what the effect of inflation has been on the price of a gallon of milk over the long run. So if we think to all the way to today and all the way back, let's say 1930, what we've seen is that back in 1930, a gallon of milk was about 30 cents. Over time, what we've seen is this number, not this smooth, but over time it's climbed. And then in the 60s, we saw that that was about $1 at that point for a gallon of milk. Same gallon of milk. Now there's going to be changes in the cost of production and all those things that impact the price, but generally speaking, the price went up. Not because the milk got that much better, but just the value of the dollar went down. So the dollar buys less things. You need more dollars to buy the same thing. So in 1960, it was about $1. And then in the 80s, 70s and 80s, started to see inflation really peak up. And what we saw in the 80s was that a gallon of milk cost about $2.10. So now we're twice as much as we were 20 years before. And now if we look at the price of milk today, alternating these colors here, I saw somewhere in one of the stores that the price of a gallon of milk, and I can't tell you if this was organic or anything else, but the price of a gallon of milk was about $3.55 today. And what that equates to is not only is it about 12 times the price of a gallon of milk in the 30s, but that's basically 5% per year more expensive. And this is the effect of inflation. And this happens with pretty much everything that we spend money on, whether it's gas or cars or clothing or food or travel. There's some growth in the cost of this. And what that actually is just the value of the dollars going down. That's the cost of inflation. The important thing to note, though, about inflation is it's generally, now we've seen periods where it spikes up a lot in the 70s and 80s, and other places in the world, we've seen it really spike up. Post-war Germany and Zimbabwe are these two kind of economic anomalies where it's gone up a couple thousand%. What that means is the value is just being obliterated for the currency. But lately, we've seen it be pretty muted. And the analogy I like to use is inflation is kind of like the effect that made the Grand Canyon. If you were standing in the desert in Arizona and you just saw this stream going by, you wouldn't think much of it on a day-to-day basis. But over thousands and millions of years, what happened was this Grand Canyon was created by a really small trickle effect that grew and grew and grew. And inflation can kind of have the same effect on someone's financial structures. If not properly accounted for, it can really erode the purchasing power over a lifetime. And all of a sudden, the X dollars you're spending per year really doesn't buy you what you used to. So this is an integral part of planning that, especially now with having historically low inflation to this point and being in a low interest rate environment, we really want to talk about and think about how's the dynamic changed and do we need to do something differently? And so we'll talk a little bit about that. And really, quite honestly, this is something that's really specific to every single person's plan and is integrated into the financial structure. So it's really tailored to everyone's needs. Now, I wanted to talk a little bit more about these kind of bonds and the different types of bonds. So we've talked about the nominal bonds and the inflation-linked bonds, but not all bonds, even not all nominal bonds and all inflation bonds, are the same. There's two different things that change how they perform and what they bring to the investor. And the first is what we call the term structure, and this is basically, the term structure is effectively how long is that bond before it matures. At what point does it mature? Is it a 5-year bond? Is it a 10-year bond? Is it a 3-month bond? And what we see is this is the term in years, and so left to right, short-term bonds to long-term bonds. And then on the left-hand side, we have what's called the yield. And yield is the interest that gets paid. And this is what everyone sees as the coupon payment. It's really important for evaluating how it fits into someone's plan. And what we see is, in general, normal times, we see that shorter term bonds pay generally less than longer term bonds. There's less time for something to go wrong because we believe risk and return to be highly related. So if there's more risk, there ought to be more return or more yield. So in normal circumstances, we'll see where short-term bonds pay little relative to 30-year bonds or longer term bonds. So, and this is incremental along the way. And this is what we call the yield curve, and it's upward sloping. And over time, it starts to kind of flatten out. So we'll see this kind of short-term range, probably about 5 years, and then this intermediate term range, about 5 to 10 or so, and then 10 and beyond we consider to be long-term. And so what we need to understand is, with longer term bonds, yes, they can have a higher yield, but they can also carry a greater risk. So it needs to be balanced. The same is true of the credit quality. Is the lender, or excuse me, is the borrower credit worthy? So if someone's borrowing money from you and you know that they've rarely paid their friends back for whatever it is, you're probably going to expect that either they're not going to pay it back or you're going to want some extra return on it. You're going to want some higher yield. So when we're looking at fixed income vehicles and providing for some stability, we have to evaluate the two types of risk, is the term risk and then the credit risk. So this yield curve can also be applied to the credit quality of the bond. The higher quality being yielding lower and the lower quality yielding higher. Now, the next we want to talk about is, where have interest rates been historically and where they're at now? So when we look at where interest rates have been, I'm going to use a really short time period relative. Now, it feels like a long time period because it is kind of, it's usually about somewhere about the lifespan of our clients to this point and the people that we know. And I'm just going to focus in on the 1960s to about 2019 specifically. Now, I actually read an interesting study. As I mentioned, I'm the nerd in the office. I love thinking about all this math stuff and getting into the nitty-gritty of it. But I read an interesting study that someone, a PhD, had figured out a way to calculate what have been the historical interest rate environments for the past 700 years. I never thought I'd see 700-year data on anything. But we have an interesting study on that. And basically what we've seen is, from the 1300s to today, there's been an aggregate downward trend of interest rates, kind of like what we did experienced in the past about 40 years. So there's been this general trend of like 700 years of decreasing interest rates. But over the past basically 60 years, what we've seen is we saw a rising interest rate environment from the 1960s into the 1980s, and particularly 1981. 1981 was kind of an inflection point for interest rates. Now there's something to note about the effect of interest rates on bonds. You've heard, if you've been working with us, you've heard us talk about, or if you've worked with any type of planner or any advisor, you've probably heard that there's this inverse relationship between bonds and yields. So as interest rates go up, we notice that bonds, generally speaking, go down in value. And what that is someone can go borrow the same credit and term bond, but get a higher interest rate. So why would they pay you the same dollars to get something that pays them less? The alternative is true, where interest rates go down, generally speaking, bonds will go up. So in this time from 1960 to 1981, we saw a rising rate of interest across the board on average. And what that actually yielded was, after accounting for inflation, there was actually a negative return on bonds. So while we expect bonds to be a positive component of the portfolio, there's periods of time where if rates are rising, the real return on bonds after accounting for inflation and the actual what we call purchasing power, what can you consume, we actually saw a negative performance on that. Depends on which kind of interest rates and bonds you're looking at, but for example, the 10-year Treasury lost about 0.8% on average after inflation over that time. Now, from 1981, we saw actually, I believe it was June, so we'll say J, 1981, we saw a high on what's called the federal funds rate. The federal funds rate is like the loan that the Fed gives to banks overnight, super low rate, short term, high quality. This is not something we're investing in or people can invest in, but this is what they're lending banks to provide liquidity. And that hit a high of 19.1%. I can't think of any interest rate now except for maybe credit cards that are or used car loans potentially that are 19.1%. Now this is an overnight rate. This isn't even like a 5-year car loan. This was a really high period. So if you remember the 70s and 80s, there were periods of pretty big inflation, in some cases double-digit inflation here. So things got more and more expensive. From that point on, though, what we've seen is a bumpy ride down, but a general trend downwards of interest rates. And then right after 2008, they dropped really low, and they've been climbing. And then 2018, 19, and 20, we've seen them fall again, and this is a response that sometimes the Fed will do if it's seeing that there's economic slowdown. They're trying to bolster the economy. What we've seen though is now today we're actually seeing about the federal funds rate at 0.1%. So going from 19% down to 0.1%, that's a pretty substantial decline. And what that's done is it's actually provided really healthy returns for bonds. And so depending on what types of bonds you're looking at, for example, the Barclays Aggregate Bond Index for the U.S. is kind of a look at the entire fixed income market in the U.S. And it's kind of the benchmark index if you're looking at short and long-term bonds. It's just the average of everything. Over this time period, it provided about 7.6% return before inflation. And then after inflation, it's like closer to 4%. There's about 3% inflation over that time period. And that's a pretty healthy return. But what we notice is a lot of that has been driven by that general trajectory downwards of interest rates. So that's something to really think about. Do we expect that to go on going forward? Now, we're at basically zero interest rate policy today. And there's places actually in the world where there's negative yielding bonds. So some governments have actually, around the world, have actually issued bonds that have a negative interest rate. So effectively, you're paying them back. So what we have to evaluate is what do we think is going to happen going forward? And when I was in grad school getting my master's in economics, I had a professor that worked at the Fed, spent some time at the Fed in the economics development division, and was a researcher and was involved with policy. And one of the things he said was harder than anything else to forecast. And they run a forecasting center for businesses and local municipalities. And he said that there's nothing harder to forecast than interest rates. And that's a function of a number of things. There's market forces, but there's also political influence in that, right or wrong. There's no opinion stated on that. But that's the reality, is that there's also political action that can result in changes in interest rates. Now, one caveat on that is that the Fed might set policy for what they would like interest rates to be at, and it's kind of sets the tide, the level of the tide of where they should be or where they think they should be, to incentivize different types of economic activity. But there's still market forces that are extremely powerful. And to this point, it's generally followed Fed's guidance on where interest rates should be. So if the banks are borrowing at a lower rate, then they usually loan at a lower rate. But the borrowers also have a say in this to some capacity. If in aggregate, everyone else agrees, you know what, we need higher returns because inflation's going up or risk is going up, well, that might actually deviate from Fed policy. And that's a real possibility. We haven't seen it substantially yet, but market forces may actually increase interest rates. And as we talked about, the relationship between where rates are going and what bonds are doing is negative. So if interest rates rise, we might see a decrease in the value of bonds. And so something to be cognizant of. Now, kind of last point, which is really the crux of all this, is because we don't know where interest rates are going, we know where they've been, we have expectation and hopes of where they'll go, just like we do with stock markets or any other investment, honestly, private business or anything like that. We have expectations, but we can't perfectly forecast, especially with something this big and this integrated with, I mean, just everything in the world. There's so many different players in this kind of game. So we have to think about the different scenarios that could manifest. And this is kind of getting to the point of what are the conversations that we're having and how are we addressing them, quite honestly? And how do we think about planning for the next year or 50 years, whatever that might be? So if we think about where we're at today, we've got three kind of different scenarios, kind of a range of scenarios, and it can fall anywhere between these three, basically. So scenario one is rates start to climb. Now, there's a short-term, an intermediate term, and a long-term effect with all of these. And for every single person, the impact is really going to be different, and the implications are going to be different. But if we see rates climb, what's our expectation with bonds? They'll go down in value. So that's might be some discomfort in the short term, and these long-term bonds and these lower credit bonds might be affected greater in a bigger capacity than the shorter term ones. So we have to, again, this is a risk evaluation relative to someone's needs and understanding the trade-offs between them. So one of the risks is that as the interest rates climb, the bonds lose value. But what's happening is bonds are going to be reinvested. So there's probably going to be some short and potentially intermediate term discomfort, but you're hoping to be able to reinvest at higher interest rates later. So that's one consideration. Number two is rates stay the same. And now we've talked about, this has been great if you're a borrower. If you're getting a mortgage or refinancing, this is fantastic, right? You're going from paying 4 or 5%. Actually, I remember my dad told me his first mortgage rate was, I think it was 11 or 12%. And now being in the world where we're talking about this regularly, I'm thinking, 3%. And I even saw one online provider provided a 15-year fixed at 1.75%. And I can't believe how much lower they are today than they were before. But the reality is if you're a borrower, this is great. If you're a saver, this might not be as great. So on the flip side, we hear conversations a lot about my savings account, my high yield savings account is paying 0.5%. It used to pay 4%. That's the reality. These rates rise and fall together, generally speaking. So what we see is if rates stay the same, bonds might stay the same, but they're also not really going to pay any more. There's going to be fluctuations, of course, over that time, but bonds will kind of stay the same. So it's important to identify that's a reality too, is they might just kind of stay low for a while or permanently. We just don't know. There's been some development in terms of Fed policy around inflation and interest rates dating back to August. They just recently changed their policy. One of the Fed's policy mandates is to keep stable prices. And the way they look at that is, and when I say prices, it's the cost of things, inflation. They've always targeted about 2 or 3% on shorter time periods and averaging that. But now what they've decided to do is they've decided to actually look at that 2% target or that 3% target and think in terms of longer term averages. What that means is we might have a few years of rising inflation because the average is going to be, there's going to be things above it and below it. And so if it's been running below for a long time, there's thought that it's going to actually rise and stay above that for some time. And so this is part of the conversation we're having with clients, and this is a new development. So we're looking at the implications, not just broadly speaking, but really importantly, is specifically to everyone's planning. So that's something that could happen as well. And the third is, and this is possible, we've seen this happen around the world, is rates fall. And what does that mean? This is a particularly interesting one from an economics perspective, and also has a lot of implications from a planning perspective and from finances. What does this mean? If we think about where we were before with this 0.1%, if we go below zero or to zero or below, that's a place that the U.S. hasn't been before. It doesn't mean Armageddon necessarily, and this isn't supposed to be a scare tactic of any kind, but this is something to think about. What does that mean? Well, we know there's a couple of things that drive the return on a bond, and that's what we talked about before is the yield. What is it paying? And then there's also the appreciation factor. So if we think about the return on a bond, I'm going to draw this in the bottom left here, is equal to that yield, that annual payment that we're receiving, plus we'll call it appreciation or depreciation. Is it growing in value or falling in value? And that's a function of interest rates. So what happens is that all of a sudden we might have this dynamic where we have a negative yield, and then for the short term we're going to have a positive appreciation. But now we're in a negative rate environment, and this has a different implication for planning, and it's something we need to be cognizant of. And not a lot of people in the industry, quite honestly, are talking or thinking about this. They're kind of expecting this really healthy return that we've seen from bonds, but the concern is the only way to get that is to continue to push rates negative and negative and negative, and that's a possibility. But we can't rely on that huge healthy return that this intermediate term and long-term bond index has provided. And a lot of people are planning on that. And we've noticed this is a trend in the industry where for probably about 10 years, people haven't really been paying attention to that fact and thinking about it. And so it's really important. And when we're planning, and we've been doing this for many years, is thinking about the reality of that situation of we can't always expect rates to continue to fall permanently. And if they do, they have implications on the other side. So a lot of people aren't thinking about this, but what this means in the short term is we might see bonds rise if the rates continue to fall. But now we're investing at lower rates every time the bonds come due. So there's these competing objectives in a sense of the yield and the appreciation. And the most important thing is that the financial structures are reflective of your needs, your family's needs, and they're protective of those. That's the most important thing. We like to use a little bit of alliteration, is reflect and protect your priorities. It's so critical. And quite honestly, most of the planning industry is thinking about this risk and how to do it. And so since about 2008, we've developed, if you're heading towards retirement or in retirement, you've probably heard us talking about the SAIL planning, the strategic allocation for income and longevity. We've been implementing a strategy around this, knowing these different types of risks that exist, especially in the stuff that's supposed to be stable. We've been developing and running this program for 12 years. And actually 2020, we've been developing basically what we call SAIL 2.0. And this is that priority focused planning that actually looks at some of the inherent risks of these fixed income components and really identifies, are we taking the right risk? And we've been pleasantly surprised that we've been really accounting for this for many years. And so we're really confident that we have one of the best solutions, the best of class solutions right now to deal with the fact that we're in extremely low rates with the potential of any one of these three outcomes. And that's really important. So one of the big questions is, how do we plan? How do we plan for the fact that we have low interest rates today? I think the most common is, why am I buying low coupon bonds? And the true and frank response is, even though they're low yields, they're there to be protected for you. A lot of times you'll see that people are still chasing yields because they've always had 4 or 5% coming in from their bonds, but at the expense of potentially greater risk, and that's a concern. And so when we're building financial structures, it's important to identify these risks and to really think about, is this the right type of risk to take in this case? So we're really cognizant that every piece of the portfolio is there for a very specific purpose. And even if there's low rates, it might be most appropriate because it's too valuable of a priority to allow low credit bonds, or especially stock market exposure. It's not reasonable to put some of your most important priorities at risk for that. And so we have to be really cognizant of what's out there and what do we have to accept in order to be safe. And so that's really important. So again, there's no way to predict where they're going, but we can, one of the quotes we like to talk about is, we can't dictate negative events, but we can really impact how they affect us. And so building protective strategies is what we do really, really well. I'm going to take my screen off here for a moment. So with that, again, the focus here is building financial structures that really reflect and protect our clients' most important values and their purpose, honestly. So if you have any more questions about how this plays into your financial structures and how are you protected and what is the low interest rate environment and potentially a change in that look like for you, please reach out to us. We'd love to be a resource for you. If you're already working with FMB, this is a conversation you probably already had, or we're developing currently. If you're not working with FMB, but you're curious on how this might play into your financial structures and how to better protect yourself, especially with the things that should be safe, and you just have questions around interest rates and bonds, please don't hesitate to reach out to us. You can call us at our main line or go onto our website and reach out to any one of us, and we'd be happy to talk about what are these implications for you and how to better protect you and your family and the next generations and really support your needs, especially with all the uncertainty that exists in the world. So with that, we're so grateful you could spend some time with us today. And again, if you need anything at all from anyone here at FMB, please give us a call or go to our website. Have a great day.